It's the question we were debating this morning at 4 a.m., not 2 a.m. But we actually think that the earnings are pretty resilient from here. And we've been saying, we sound like a broken record. And
you have been.
Right?
Yeah.
And you think, surely the risk of recession potentially is rising here. And I think it would be naive to say it's not. That chart that you're referencing, a stagflationary risk scenario, is really starting to come into frame. But when you look at what's happening with the earnings power in U.S. equities today, we're seeing companies continuing to maintain that optimism. They haven't cut their forecasts yet. Whether that's a degree of uncertainty or unwillingness to acknowledge energy prices or not yet.
Yeah, we should say $98 a barrel. I don't think we
absolutely.
Will.
So, Adam, here in the U.S., how do you think about asset allocation? Stocks, bonds, commodities, alternatives? Where are you guys today versus maybe where you were at the beginning of the year?
So where we are today is really starting to wonder about the diversification pieces of our portfolio that have worked to this point. So things like energy. Look at the volatility that we've now had in the energy price. Can any of us actually map out, I'm not smart enough anyways, to figure out the spread between the futures market in energy and the physical market in energy? So you look at the dated spread, the dated Brent rather. And so from an allocation standpoint, we still like equities. The question is, do you start moving back into government bonds for that downside protection as recession risk starts to increase from here? The valuations are coming back a little bit right now, so maybe that's an attractive play.
And in U.S. equities, we had, I think, starting late last year, heading into this year, a rotation out of what had been kind of the higher multiple, higher growth tech names, Mag 7, into some more cyclical kind of stories, even small to mid cap for that matter. Was that a short-term trade, or is that something we should be still thinking about?
I think there's some short-term trades out of that. I think particularly in the small cap market, we have yet to see really that durable earnings coming through in the broad market. So you have to be very selective, we think, within small caps. When you look at that cyclical trade versus the more defensive trade, a lot of that is going to hinge on, do we get that stagflationary outcome? Technology, I think, still has legs to go on it, despite all of the disruptions. You were talking about private credit. I mean, we're getting into private markets here, but when you look at Anthropic, they grew from 9 billion to 30 billion in revenue, right, over, what was that, 9 or 12 months? And that was limited by their access to compute.
Right. Does all the earnings growth come from such a narrow set of sections? My reading over the last 72 hours is everybody's revisiting this question. Like Paul, it's shocking if you say, okay, there's 10% earnings growth, where that growth's coming from. Discuss.
I mean, it is so interesting, Tom, because we have seen this playing out, and that concentration does continue to drive the earnings premium in the U.S. And I'll give a shout out back to Bloomberg and the brilliant Odd Lots podcast from Saturday, when they talked about the difference between earnings and free cash flow in this paper that's out from the Fed, because that actually goes to the heart of what you're talking about. Free cash flow has been driven higher by the earnings of tech specifically. If tech is becoming more capital intensive, what happens to free cash flow? It goes down.
Yep.
So what does that mean for the U.S. equity market? I think this is what we're going to be wrestling with over the next 36 months.
Can't they just issue bonds, Paul? Come on.
Yeah, they could.
You're at Duke.
The market is open.
You're at Duke. It's an 80-degree April afternoon, and you're doing Merton and Modigliani.
No, I'm on the golf course.
Just issue bonds.
Yeah, exactly.
That's what Schiffman would say.
Yeah, exactly. No problem there. So, all right. So we do have this higher energy complex out there. It seems like it's going to be higher for longer. What does that mean for inflation? What does that mean for growth? Are you guys changing your outlook or changing your position, your portfolio?
Yeah. So I think the first thing to reiterate here is this idea that none of us has certainty on what path happens from here. It hinges on the next tweet. And so this is where the scenario analysis really matters. If you map in a scenario of $150 a barrel oil for a protracted period of time, we see that pushing inflation higher by almost 1% over time. When you think about the second order impacts, right? Because it's not just the energy price itself. And that's where we think you actually have to spend your time now. What happens to food prices? What happens to manufacturing input prices?
Right.
What happens to labor with this uncertainty about AI?
But to go back to your academics and your great work, Adam Farstrup, over the years, I'm going to answer that corporations are incredibly malleable and they have lots of width to cut expenses if they have to. That's the history of our lives. They cut with a vengeance when they have to.
That's right. But what happens to demand destruction in that scenario when we have all these questions about the labor market?
So what do you model in GDP for it?
So you model an initial hit with no dynamic response to GDP of about 50 basis points on GDP. But this demand destruction is the thing we now have to answer, because look at just, we've had this discussion of airlines and saying, we're resilient, we've got hedges in through May, but what's happening in Europe right now? Europe has said they've got 2 weeks of jet fuel left, right?
I agree with you on this, because full disclosure, folks, I got half my family on the phone to the Pacific Rim. Thank you, Mr. Leger, T-Mobile. I'm always supporting him. I mean, this is not in the American zeitgeist right now, that they're running out of things.
Yep, that's right. So when you run out of things, right, it's almost, our commodity team talks about it like a reverse COVID situation, right?
I haven't heard this. It's good.
So you think about, we've ignored running out of things, and that supply shock might be coming across the board. Rationing. I mean, you're talking about gas stations in Australia not having diesel fuel right now.
Yep.
Manufacturing might not be open 5 days a week in parts of Asia.
Right.
And the tankers, right? There's a great chart out there. The tankers, the last orders are actually coming through. So we've had the physical supplies coming through, and now the tankers are running out.